the TheoTrade. This is Don Kaufman. February 3rd, 2021. Here we are on a Wednesday afternoon with, well, a veritable slop fest inside of the marketplace. The S&Ps are up. The Nasdaq is down. The Dow is up. The Russell is up. And this has me actually questioning, are we about to see really another volatility storm hit the marketplace? Let me explain in a bit more detail here. Let me start this evening in one of the areas that we talk about just incessantly here at TheoTrade, and that is specific to the SPX and the expected move. Now, to get everybody up to speed, if you've kind of been tuned in, phenomenal. If you're not, the expected move, that is a weekly move depicted by specifically the options, of course, in the SPX. And the expected move, all right, so EM for this entire week was plus or minus roughly $132. We hit it. But we hit that edge of the expected move literally by Tuesday. So what do you got for, Wednesday, which we just passed through, Thursday and Friday? Got absolutely nothing. But I'll tell you what, today, pretty much the entire trading day was all about what we kind of term skirting the upper edge of the expected move. And for those of you, again, that kind of follow these expected moves, let's actually cruise into, from a daily chart, into a 1 day, 1 minute. And what you're looking at right here, that's the upper edge of the expected move. The upper edge of the expected move is literally in the SPX. SPX is going to differ a little bit from the S&P futures, right? So it's SPX specific. That is going to be 38.47. When I say we skirt the upper edge, literally the marketplace opens, sold off a little bit, come up, literally tagged it. To pretty much the penny, people. We again, you got to look at this. It's this $3,800 product that's literally tagging a specific level, and it's driven to those levels by dynamic hedging. Now, a lot of people have heard the term lately, like gamma squeeze and so forth. You got to look at the edge of the expected move. It's where gamma is relatively happy. Okay, now why might we consider that? Well, we could be on the edge again of another bit of a volatility storm. There is some highly detailed research I've actually done regarding the SPX and the weekly expected move. Again, it says you're supposed to move $132. So how often is it supposed to stay in that range? Well, that's the higher probability trade. Here's that $132 range. You're supposed to stay in that range one standard deviation, which is 68% of the time. However, if you look back, historically speaking, if you see a major breach, and we just saw a breach in the previous week, and it was a very substantial breach of expected move, breaches tend to coincide with more breaches. So if you look back at some of the data, and I'm just actually going to back up in this particular case, it's actually back up, for instance, 3 years. All right, so I have 3 years. Now, this is 3 years of literally like hand-drawn expected moves. And one of the points I'll make is, again, expected move is it's kind of the change, if you will, from like efficiency in the marketplace to relative inefficiency. So here's a patch of time, and I'll just show you. When I say a patch of time, there's a period of time like that's a breach, but it's so negligible. That's a breach, but it's incredibly negligible, right? Here's another breach, like they're few and far between. What I'm showing you is a period of incredible efficiency in the marketplace. Then, okay, by the way, this is the onset of COVID, which is an unusual time in the marketplace. We broke to the downside. We broke to the upside. By the way, that's before anybody knew what a COVID really even was, right? It was break to the upside, break to the downside, break to the upside, break to the downside again. Then all of a sudden, we hit this incredible patch of volatility. I'm in no way alluding, okay, to the fact that we're about to hit that kind of a patch of volatility. But I will tell you, again, breaches of expected move tend to follow other breaches of expected move. Periods of efficiency in the marketplace. Okay, this is a completely efficient, leading to complete and utter inefficiency in the marketplace. And anytime we have a breach of substantial nature, which is something that I would absolutely categorize as to what we saw last week, this has me, this has me on my game. It has me on my game. It doesn't necessarily mean, okay, that we're going to break to the downside. Now, I don't want to be, categorized all the time. Like, he's a bear, he's a bear, he's a bear. Yes, I'm carrying bearish positions, okay? But when I talk about like a volatility kind of storm in this particular case, that initial break, okay, could absolutely unequivocally be to the upside. And the upside break leads to more, okay, inefficiency in the marketplace. Then we ultimately snap lower from there. Okay, there is no question. We've already had 132-point move this week. There's no question there's still volatility packed into this marketplace. In fact, when you look just out between today and Friday, I mean, all we have left is Thursday, Friday, right? We still have about $40 of expected move. So the expected move has come down all the way from $132, on last Friday. It's all the way down to $40, $41, whatever. There's a jobs number. It's neither here nor there. All of that is priced in, and that's important, okay? But I'm telling you right now, be on your game. We could absolutely break to the upside and then ultimately collapse back down. And that's why I'm saying we're on the cusp of a little bit of a volatility storm. There's some other things that I'm watching inside of the marketplace. I never look at anything in autonomy. I don't look at a marketplace and go, well, just based on expected move. That doesn't make any sense to me. I always look at relationships. And one of the things I looked at a lot is advanced decline line, total slop fest. As they started today, I'm like, this is going to be a slop fest of a trading session. But the unusual thing that caught me off guard today is that the Nasdaq, the Nasdaq was the underperformer. Amazon and Google both had earnings, obviously, last night. Both knocked it out of the park. Google's up by the tune of over 7%. Would you have expected the Nasdaq to actually be defecting to the downside today? Absolutely, unequivocally not. Earlier in the week, we heard from ExxonMobil and so forth, and some of the earnings that came out in the energy sector. Would you have guessed this one was actually going to be up today? No. Okay, there's actually a sector rotation going on right now. It just doesn't necessarily resonate with me. It doesn't make a whole lot of sense in here. Again, it's another reason I might look for some volatility to come back. Now, at the same time, I'm looking for volatility to come back. You're looking at the VIX and go, nah, the VIX is collapsing back down. I'd agree with that, but the VIX is collapsing back down because the S&Ps are, stone's throw away from the all-time high here. The VIX should be collapsing back down. In fact, when you look at the VIX collapsing back down, okay, listen, this is very secondary, but I look at this as more opportunistic than anything. The other aspect that really is sticking with me right now, the bonds. The bonds right now are about to trench lower, okay, than they have been in very considerable period of time. Again, we got to start opening up, some really substantial size charts to actually see the bonds collapsing back down like this, which is actually going to take, this is now the 10-year. I'm going to go to the TNX. Okay, the TNX, this is on a 3-year basis, but if you actually drop it into 9-month, we're clear into over the 1% in the 10-year, and it looks like it's going to continue to fly higher. With this, so some people say that this is a sign maybe of inflation. Okay, could be. I mean, obviously there's a huge stimulus bill that's about to come out. Maybe they're pricing in a little bit of inflation. But if that's the case, why does the dollar not sell off, right? If there's going to be some inflation over here, and for the most part, huge stimulus bill, you would think that the dollar's going to sell off, and it's not. One of the things, again, that really stands out to me, it's the entire dynamic of the marketplace. Okay, some things look a little funky to me. We had a extraordinary expected move this week. We're seeing all kinds of volatility in the last few weeks of trade, but the dollar rallying, this looks like, again, the world right now seems nervous. That's why I think they're actually buying dollar. They seem nervous. And again, you can come up with, 1,000 different reasons why they might be buying the dollar. But the bottom line is with a huge stimulus bill, okay, out there of another 1.9 trillion after another stimulus bill, then we're actually going to see, all kinds of monetary policy still being done. You wouldn't expect the dollar to rally than people are actually scared to possibly be within their own currency. And I've said this, 100 times in these videos, and I'll say it again. Why do people buy the dollar in times of fear? Because in the end, okay, the dollar is probably going to hold up better than the euro. It's going to hold up better than the yen, the yuan. Okay, I mean it's the currency that everybody wants to be in. It's my my quote over here is our crap, meaning our dollar, is better than your crap, which is your dollar. And that's why people actually come in here. And this, okay, could be a sign of volatility forthcoming unto itself. The last thing I'll actually leave you with, and this is a little bit of like a cynical idea in here, and I'm ever the cynic. That's why I carry some bearish positions, right? Here's one of those ideas, and that's simply this. Okay, you got to be extraordinarily careful in the marketplace. I'm not here to tell you whether necessarily to get bullish or bearish on any given day. Okay, I'm out there and I'm selling out of the money, premium. We're doing phenomenal with it, but I'll tell you right now, okay. To me, this is not a time to go out there and rush out and look for deals. You're not buying any stock right now. Use defined risk spreads, okay, whenever and wherever possible. You're going to get bullish use a defined risk spread. You're going to get bearish, use a defined risk spread. Because here's ever the cynic in me, and ever the cynic in me, this marketplace is going to be phenomenal at roping in as many people as possible before actually descending. It will descend, it will rally back up, it will descend again, and it will rally back up, literally roping everybody in. And it is my belief, and again, this is the cynical side of the business, my belief, GameStop was probably likely, okay, one of that, if somebody was to hold like a street sign up and say, "It's over, baby," okay, it was what went on with GameStop, what went on with silver, what went on with cost, what went on, with AMC. These stocks are a signal, not necessarily of just purely a top, okay? I'm trying to rope, if you will, a lot more people and a lot more capital into this marketplace. And you learned a little bit over the last couple of weeks about gamma squeezes, okay? Always remember this. The gamma squeeze, that's a non-directional idea. When we start to actually push to the downside, we think people aren't going to hop on that one, okay? Listen, keep your hands and feet inside of the vehicle at all times, because even this next 2 days, this could be a rockin' marketplace. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.